It's been a short week with Memorial Day, but through May 29th, the S&P 500 is up 1.6% and the Nasdaq 100 is up 2%. Pullbacks continue to be shallow, and it's our view that they'll remain shallow because this is still the most hated stock rally. Now, what do I mean by the most hated stock rally? Well, I mean, it's been a V-shaped recovery, and investors really have been skeptical during that entire rise. I think it comes down to a sizable perception gap that, in our view, the tariff war and concerns have a bark worse than the bite.
Tom Lee highlights the resilience of the ongoing stock rally, calling it the most hated rally, as skepticism remains despite strong gains in the S&P 500 and Nasdaq. He attributes this to a perception gap, where fears such as US-China tariffs and economic uncertainties have been less impactful than expected. With resilient earnings, dovish Fed policies, and sidelined cash, Lee sees conditions ripe for further market momentum. Meanwhile, Michael Saylor underscores Bitcoin's potential, emphasizing its volatility as an opportunity for patient, informed investors. He believes Bitcoin's scarcity and growing institutional interest make it a long-term hedge against fiat devaluation. For Saylor, the current price levels represent a fleeting chance before institutional adoption drives prices into millions. Bitcoin's mid-2025 landscape is marked by consolidation and increasing accumulation, with exchange reserves hitting historic lows and global liquidity expanding. Analysts predict a significant breakout as macroeconomic factors align, with Bitcoin poised to benefit from dovish central banks and growing recognition as a scarce, fixed-supply asset.
Yesterday, on May 28th, the International Trade Court ruled against the Trump tariffs. Now, it didn't remove all of them, but it ruled against them. And on Thursday, May 29th, the D.C. District Court Judge Contreras ruled that tariffs are illegal. So it's two cases ruling against White House tariffs. But on the same day, the Federal Court of Appeals issued an administrative stay, which reinstates the tariffs at least through June 9th. But you can see this is getting quite complicated. And the White House is insisting nothing has changed after the tariff rulings. And in fact, Goldman Sachs highlights that there's many measures the White House can take to implement or re-implement tariffs. But ultimately, the White House is losing leverage, and it's taking us closer to the end game because it's going to be difficult for the White House to re-escalate things when they're losing really court cases. And so I think what we're probably expecting is the White House to look for an off-ramp. Now, this is not a surprise because tariff threats have led to concessions, just like the Doge cuts, even though they're less than expected, have led to concessions. And even this budget and reconciliation bill, they don't have the cuts people are expecting in spending, but they have concessions. Now, hedge funds have increased their short interest recently, and that's contrary to what you expect, because when the market's rallying, you think hedge funds should be covering their shorts. But that's not the case. How short interest is increasing for the average stock. And there's still $7 trillion of cash on the sidelines. But maybe most importantly, and I've said this before, the investment outlook is better for stocks now, arguably, than it was in February 2025, because you've got tariff visibility, you have tax and deregulation visibility. The companies survived the fifth major stress test, which I've covered before, which argues multiples should be going up. And the Fed is arguably more dovish next year. Now, President Trump and Fed Chair Powell had a meeting today, but no surprise, it's not as if the central bank has changed their minds, and they're saying that they're going to support maximum employment and stable prices and will make the decisions solely based on objective, non-political analysis. Well, in my opinion, that means that it's going to be easier to make the case for cuts in 2026. Well, that's a dovish Fed next year, which is really, as you think about it, 6 months from now, that should be positive for stocks.
Tom Lee sees the current stock market rally as strong but doubted, driven by solid earnings, supportive Fed policies, and sidelined cash despite lingering fears. He believes these factors will sustain upward momentum. Michael Saylor highlights Bitcoin's limited supply and growing institutional adoption, calling it a valuable, long-term asset. With low exchange reserves and favorable conditions, analysts predict significant price growth, cementing Bitcoin's role as a top store of value.
Volatility was a gift to the faithful. It scares away the tourist. It scares away the lazy. It scares away the people that are already conventionally rich, that have all the money. If you're a 20-something or a 30-something and you're willing to do the work, if you're willing to spend 100 hours or 200 hours, if you have more time than money, then the volatility of Bitcoin is a gift to you. If you have more money than time and you're arrogant and egotistical and you just pick the obvious, then if the volatility goes away, you buy Bitcoin. If people in the rest of the world knew what I know and they understood and they agreed with me, Bitcoin would go to $10 million tomorrow. And if Bitcoin went to $10 million tomorrow, I want you to think about how you would feel and how your viewers would feel, because you would lose 20 years of stacking opportunity during which you get to buy at less than $10 million. So the difference between $10 million and 100,000, that's what you give up if the volatility goes away and people start to agree with you.
Tom Lee highlights the resilience of the ongoing stock market rally, citing strong corporate earnings, supportive Federal Reserve policies, and substantial cash reserves on the sidelines as key drivers. Despite widespread skepticism, he argues that these factors create a robust foundation for continued market growth, emphasizing the importance of staying invested and recognizing opportunities amidst uncertainties. On the other hand, Michael Saylor delves into the growing prominence of Bitcoin, describing it as a unique, limited-supply digital asset increasingly embraced by institutions. With dwindling exchange reserves and favorable macroeconomic conditions, Bitcoin's trajectory points towards significant value appreciation, solidifying its position as a critical component of modern investment portfolios. Together, these perspectives encourage investors to carefully evaluate both traditional and digital asset markets for diversified, forward-looking strategies. Do you think the current stock market momentum will hold up in the face of potential economic uncertainties? How do you see Bitcoin evolving in its role as a store of value in the coming years?